So let's talk about these jobs numbers with Eugene Profit, who's a portfolio manager with Profit Investment Management, and he joins us from our Washington newsroom. Good to see you. And I understand you have a history as a professional football player before you got into the financial services industry. So, you know, we're going to bang some heads here and talk a little bit about the jobs numbers. And when you look at these numbers, so we see the 8.1, so that's a tick in the right direction. But the number of jobs, the number of new jobs created, Eugene, a pretty paltry 115,000. What is it telling you?
Well, that we're in a muddle-through economic environment. Essentially, the only good news that I saw in these employment numbers was that you had a 54,000 revision to the past 3 months, which pretty much puts it in trend line. I think you actually are getting a little bit of an adjustment back from good weather earlier in the year, and you're seeing that the economy, although it's improving very slowly. You see services are up a little bit year over year, but manufacturing is way down. So net, I think more of the same. We're going to muddle through.
What does that mean then? If we're looking, you know, because obviously everybody wants to know how this is going to affect the election in November, and the thing that I keep reading is that no president has ever won re-election with unemployment higher than 7.2%. I don't think anybody thinks that there's a chance that the unemployment rate will drop almost a full point between now and Election Day. But where do you see, if muddling through month over month as we get into the fall, what's it looking like to you?
Well, I think that essentially the stock market has actually done okay over the past 18 months to 3 years, right? And so the wealth effect overall is relatively good. The U.S. consumer has, for the most part, been strong. Inside of those jobless numbers, you did see hiring and retail sales being okay, even though when you look at the retailers, they're missing their earnings over the past few days. You are correct. No president has won with an unemployment rate as high as the unemployment rate is currently. But we've had a little bit of a structural change in our economy, coming off economic environment, second only to the Great Depression. And so I think as long as the stock market holds up and doesn't collapse, the sitting president has a reasonable chance of being reelected, the first one elected with that high of an unemployment rate.
He would be making history, the first one since FDR back in the Great Depression. You know, I just wonder, when, you know, people, obviously, if you're the president of the United States, you're going to take the credit when things go good, and you're going to get blamed when things are not so hot. But realistically, the policies of a sitting president of an administration, how can they affect, you know, sort of, you know, the unemployment rate? A lot of people are quick to say that the Obamacare, that the health care law is something that has really had a negative impact on jobs growth, because a lot of employers out there don't want to take on the added costs that Obamacare brings when it comes to having to employ people, and that's a disincentive for companies to hire. Do you see it that way? And how big of a role do you think the president has had on the job situation that we've got today?
Well, I think the most important issue is confusion over policies and confusion over what the economic environment is going to be. You are correct that the increased cost of Obamacare is a negative attribute to employers looking to hire. But business owners are smart. We've had 3 years of these policies potentially coming into place, and business owners will adjust if, in fact, that does become, you know, the law of the land and the rule of the day. The president actually has the pulpit to basically help engender a positive environment around our economy, around our stock market, and I think that you'll see more of that as we move closer towards November, more of a reflection on the fact that we have been in a bull market, albeit not a strong bull market. We did come off of a very low base. Certainly, we would like a more robust growth. Certainly, there is a lot of divisiveness around the country with respect to policies on either side, whether liberal or conservative. But I think net, if you look at the U.S. consumer versus what's going on around the rest of the world, you know, we're not doing so bad. We're not doing as well as we've done historically.
We're doing better than Europe.
Absolutely. And I think that's actually going to be a major factor over the next 3 months. I mean, a lot of the stock market trend has been very similar to last year. We're coming into the summer months where Europe became a major factor. With Greece, you're about to have another election there that might have some impact on the market as recently as next week. And China, GDP growth has been slowing, albeit slightly. You might see some monetary easing there. So I think that those are some positives that might play into the administration's hands. But, net, it has been a very confusing environment to be an investor and certainly to be a business owner.
And that uncertainty, Eugene, is gonna stick around until after the election, right? I mean,
yes, it will.
People want to know who the next president's going to be. You talk about uncertainty. There's probably no greater uncertainty than that.
That's correct, and equally as important, what the next Congress is going to look like, because we're in a current environment where almost no matter what happens within our economy, the Congress is so divided that almost nothing gets done. And essentially, if we have the same thing post-election, you're going to have a little bit of more of the same. And we have some structural issues that we really have to deal with respect to Social Security, the deficit, and the debt. So I hope that the ballot box in November is going to be a very big indicator of what the next few years are going to look like. But unless we get some common ground, we're going to have a pretty difficult time dealing with these issues.
I didn't mention Eugene. Let me just let people know that they can find you on Twitter. Your handle is @ the number 4eProfit. And with a last name like Profit, you really had no choice but to get out of football and get into the investment business. So good for you to figure that out. Thanks so much for joining us. It was good to talk to you. We want to get another take on this. Todd Schoenberger is a managing principal at the Black Bay Group. I know you you had to jump through some hurdles to get to our studios today.
Such an active day.
Well, we're glad that you're here.
Thank you.
And we've been talking with Eugene about the jobs numbers that are out, and I'm sure you've seen the headlines. What's your takeaway?
They're awful. I mean, bottom line is, look, you can look at 70% of all jobs created in this country over the last 6 months are of the low-income variety. So you're looking at jobs in retail, hospitality, and leisure. This is an economy that is in desperate need of organic growth. You're not going to get that with low-income jobs. So therefore, moving forward, it's great that we have a positive print, but realistically, you're looking at 342,000 people that have left the job force. They're looking for employment. They can't find it. The average hourly earnings number, let's look behind the curtain of today's report. You're looking at 2% growth year over year. Adjust that for inflation. Those lucky enough to even have a job are losing in spending power.
Eugene's point was, though, that, look, it's not great, but it's a lot better than what's going on in Europe, that we're actually doing okay compared to other world markets out there.
Oh, okay. Come on, let's be honest here. Let's call it what it is. You cannot go 200,000 plus in December, January, and February, 120,000 the month before, and then last month see 115,000. I don't care what the revisions are. This is not good for the United States economy. Right now, GDP is trending at 1.7%, and Ben Bernanke still does not have enough octane right now to justify any further accommodation. So stock market's down today. I'm surprised we're not down further from today, but it's going to be a long one.
How do you explain, because we were talking with Eugene about the stock market, the market doing fairly well over the last couple of years in spite of this weak growth?
Right. Well, first of all, first quarter, traders were thinking we were going to have further accommodation from Ben Bernanke. He's never going to overlap monetary policy moves. So we already know that Operation Twist is going to have to come to an end, which is the end of June, before he can do any further accommodation. We don't see that happening anyway, because keep in mind, you still, like I said, a 1.7% GDP print that's trending right now off of today's data is still not enough to justify further accommodation. So he can't go to Congress right now. And therefore, to answer your question about the markets were rallying with hopes of further accommodation. Now we're down right now because we don't think that this number is bad enough to get Ben Bernanke to do anything.
Eugene, you want to respond to what you hear from Todd?
Well, he's exactly right. The number is not bad enough for more quantitative easing. And while I agree that a GDP print of 1.7% isn't our normal trend up to 3%, but it is what has been expected. Essentially, while you're talking about the jobs being created or at the lower end of the spectrum, in the financial services sector, there's still some very high jobs that are being created, and in my company, everyone made more. And let me make one other quick point.
Real quick.
When you look at what's actually being sold in the U.S. and what the U.S. economy has been made of, we're buying iPads, we're buying consumer goods, and those manufacturing jobs are being done in China. We've transitioned to a service economy, and we're just going to have to make that adjustment.
Todd, final thought from you, please.
Eugene's right. However, on Wall Street, we lost 240,000 jobs last year. We're looking to lose another 290,000 this year. We're the most pessimist people on the planet right now because we know that our outlook is not rosy. It's not looking good. Eugene, I love you. I'm telling you, I respect everything you're saying, but things are not looking good for the immediate future.
Todd Schoenberger, Managing Principal at the Black Bay Group, Eugene Profit, Portfolio Manager at Profit Investment Management, on Twitter at 4eProfit. Gentlemen, thanks so much. Good to talk.